Gold just closed the week above $5,000 for the first time in recorded financial history. Not a spike, not an intraday flash, a weekly close. And while Wall Street celebrates new highs and tells you this is normal market behavior, I'm going to show you why this isn't a rally. It's a funeral, the funeral of the dollar system. And if you think I'm being dramatic, you're about to see a pattern that has destroyed every single empire that ignored it. This has happened exactly 3 times before in history. 3 times a reserve currency nation watched gold decouple from their paper while pretending everything was fine. 3 times the same sequence unfolded. 3 times it ended the same way. Total collapse. Not opinion. Pattern recognition. And we're watching it happen again in real time. Rome controlled the known world for centuries. Their currency, the denarius, was the global reserve. Everyone wanted it. Everyone trusted it. Then the costs of empire became unbearable. Wars on every border. A bureaucracy that consumed more than it produced. Deficits that spiraled beyond control. So they did what every dying empire does. They debased the currency. Started with 20% silver reduction. Then 50%. By the time Diocletian took power, the denarius had been reduced to copper washed in silver paint. Merchants stopped accepting it. Soldiers demanded payment in gold or land. The empire fragmented because the money died first. The collapse didn't start with the barbarians at the gate. It started when people realized the currency was worthless. Verified. Check the coin records yourself. The metallurgical analysis is public. The Dutch Republic in the 17th century. Golden Age. Richest nation on earth. The guilder was the world's reserve currency. Amsterdam was the financial capital of the planet. Then came the wars. 4 wars with England. Wars with France. Wars with Spain. Each one more expensive than the last. The Dutch East India Company, the most valuable corporation in history, started borrowing to pay dividends. The government started borrowing to fund wars. Debt compounded. Wealth drained. By 1780, the guilder was in free fall. French troops walked into Amsterdam in 1795 and the Republic ceased to exist. Not because they lost militarily, because they were already financially dead. Same pattern. Same sequence. Same outcome. Check the Dutch National Archives. The British Empire. The sun never set on British territory. The pound sterling backed by gold was the undisputed global reserve currency for over a century. Then came World War I. Then World War II. The cost was apocalyptic. Britain borrowed from America to fight. Borrowed more to rebuild. By 1949, the pound was devalued 30% against the dollar. By 1967, another 14%. The empire dissolved. Not conquered. Bankrupted. In 1971, the world stopped using pounds for trade and switched to dollars. The reserve currency died, and the empire died with it. Same pattern. Same sequence. Same outcome. You can pull the Bank of England records yourself. It's all documented. Now let's talk about today. The United States has run the global reserve currency since 1944. Bretton Woods made the dollar the center of world trade. Every commodity priced in dollars. Every central bank holding dollars. Every nation needing dollars. That system gave America an exorbitant privilege. Print money. Export inflation. Consume more than you produce. And the world had to accept it because they needed dollars for oil, for trade, for survival. But that system is dying. And gold closing above $5,000 on a weekly basis is the death certificate. Here's what's actually happening right now. The United States federal government ran a $697 billion deficit in the first 4 months of fiscal year 2026. Not the full year. For months. That's the 3rd largest 4-month deficit in American history. We're not in a war. We're not in a declared crisis. This is just normal operations. Government outlays hit $2.5 trillion. Revenues only $1.8 trillion. The gap is $700 billion in a third of a year. Annualized, we're heading toward a $2 trillion deficit. And that's before the next recession. Before the next emergency spending package. Before the next bailout. Net interest payments on the debt just hit $346 billion in 4 months. That's over $1 trillion annualized just to service existing debt. Not pay it down. Just service it. $1 trillion a year in interest payments. That number was $322 billion last year. It's accelerating. And here's the nightmare number nobody wants to talk about. $9.6 trillion in U.S. marketable debt matures in the next 12 months. Read that again. $9.6 trillion. That's double the amount that matured before the 2020 crisis. The Treasury has to roll over 9.6 trillion in existing debt, while simultaneously funding new deficits of close to 2 trillion. That's 11.6 trillion in financing needs in 12 months. Where's that money coming from? Here's what else happened this week. Bloomberg published a headline that moved markets. Claimed Russia was considering a return to the dollar system. Gold and silver got hit. Volatility spiked. Algorithms reacted. Then the Russian central bank chief, Elvira Nabiullina, came out and said there were zero talks. Zero involvement. No discussions whatsoever about returning to the dollar. The entire story was fabricated. Bloomberg didn't issue a correction. They didn't apologize. They just let it sit there. This is how the game is played now. Fake headlines move markets, create volatility, shake out weak hands, then quietly memory hole the lie. But Russia made their position unmistakably clear. They are not going back to the dollar. Ever. They've built alternative payment systems. They're trading in yuan and rubles and gold. The multipolar world isn't a theory anymore. It's operational. And then China dropped a bomb that changes everything. New regulations just announced for all off-exchange gold and silver trading. For specific enforcement actions. 1. Off-exchange leveraged derivatives will no longer be tolerated. No more naked paper longs. No more leveraged paper shorts. Done. 2. Physical delivery will be enforced. No more cash settlement games. If you sell gold or silver, you deliver the metal. 3. Fractional reserve gold and silver trading will be scrutinized. No more pretending 1 ounce is 10 ounces on paper. 4. Rehypothecation of gold and silver will not be tolerated. This is the kill shot. Rehypothecation is how the banking cartel has suppressed precious metals prices for decades. Take 1 physical ounce. Lend it out. The borrower sells it. That ounce gets deposited somewhere else. That institution lends it out again. 1 physical ounce creates 10 paper claims, 20 paper claims, infinite paper claims. This is how you get a 100-to-1 leverage ratio in the gold market. Paper contracts dwarf physical supply by orders of magnitude. China just said that's over. Physical delivery enforced. Fractional reserves scrutinized. Leveraged derivatives banned. Rehypothecation finished. When the second largest economy in the world bans the manipulation mechanism, the price suppression scheme falls apart. Look at the inventory numbers. Shanghai Futures Exchange silver inventory sits at 11 million ounces. Total. On Friday, they added 126,000 ounces. Just enough to avoid default. Nothing more. China is heading into the Lunar New Year period when demand spikes. 11 million ounces is nothing against a nation of 1.4 billion people with a cultural affinity for precious metals that goes back thousands of years. Silver closed at 89.17 yuan on the Shanghai Futures Exchange. That's a $2.31 premium over Shanghai Gold Exchange spot. Gold closed over $504 equivalent in yuan. These premiums matter. When futures trade above spot within the same market structure, that's stress. That's shortage. That's the system cracking. David Morgan just gave an interview that should terrify every unprepared person watching this. Morgan, one of the most respected analysts in the precious metals space, warned that the U.S. government is going to stockpile silver. Not speculation. Strategic analysis. He explained that silver's bull market has roughly 1.5 years remaining. And historically, 90% of the gains in a precious metals bull market happen in the final 10% of the time. Parabolic. Vertical. Everyone watching in disbelief as prices do things that seem impossible. But here's why the U.S. government stockpiling silver makes perfect strategic sense. China produces only 13% of global silver. But China controls 70% of the world's refining capacity. Mining the ore is irrelevant if you can't process it. Silver ore is economically useless without refinement. You need refined silver for advanced military systems, for AI chips, for solar panels, for high-performance electronics, for every critical technology that defines modern power. No refined silver means no AI revolution, no modern warfare capability, no energy transition. The United States is desperately trying to achieve mineral and processing independence because China dominates the refining infrastructure. If China cuts off refined silver, the U.S. military and tech sector are paralyzed. So stockpiling makes sense. Secure physical supply now before the price goes parabolic and before availability dries up completely. When sovereign governments start buying, they don't care about price. They care about securing supply before it's unavailable. Now let's talk about what's not happening. Gold is at $5,000. That's almost 3 times higher than the 2022 high of $1,900. But gold ETF holdings have not reached 2022 levels. Read that again. Price tripled. ETF holdings dropped. Retail investors are selling. Institutions are liquidating their paper gold exposure. Almost nobody except central banks is participating in this rally. The crowd is not in. There's no euphoria, no FOMO, no mania. Just central banks quietly stacking physical while everyone else sells paper. This is not speculative froth. This is fundamental revaluation happening under the radar. When price triples and ETF holdings decline, that's not a bubble. That's the early stage of a monetary reset. We are not at the cliff. We have already walked off it. The ground just hasn't appeared yet. Here's what the collapse looks like for regular people. You wake up one morning and the ATM doesn't work. Not because it's broken, because the bank limited withdrawals. You go to the grocery store and prices are 15% higher than last week. Not because of a sale ending, because the currency is collapsing in real time. You try to pay your bills online and the payment system is down for maintenance. Not for an hour, for days. You check your brokerage account and your stocks are halted. Your bonds are frozen. Your money market fund has gated redemptions. You can see the numbers on the screen, but you can't access the money. You call your bank and wait on hold for 3 hours. When someone finally answers, they tell you new withdrawal limits are in place for your protection. Your protection? You go to buy gold or silver and the dealers are sold out. Premiums are 50% over spot, then 100%. Then they stop quoting prices entirely because there's no inventory. You try to buy food in bulk and the stores have purchase limits. 2 per customer. You try to buy a generator and they're backordered for 6 months. This is not a movie. This is what currency collapse looks like. And it doesn't happen over decades. It happens over weeks. Once confidence breaks, the system freezes. And freezing is the same as failing for everyone who needs liquidity to survive. The smart money is leaving. Central banks added gold reserves at record pace last year. They're not doing that because they love shiny objects. They're doing it because they know the dollar system is terminal. Russia dumped US treasuries and bought gold. China reduced treasury holdings and bought gold. India bought gold. Turkey bought gold. Poland bought gold. Even countries that are supposedly US allies are diversifying out of dollars into hard assets. They see the $9.6 trillion refinancing wall. They see the $1 trillion in annual interest payments. They see the $2 trillion annual deficits. They see the political dysfunction. They see the weaponization of the dollar through sanctions. And they're quietly exiting. Not all at once. That would cause panic. Slowly, methodically. Every month, a little less exposure to dollar assets. Every month, a little more gold in the vault. Bloomberg got caught fabricating a Russia dollar return story to crash the metals market. Russian central bank chief confirmed zero involvement. The lie is documented. The propaganda is exposed. But gold didn't crash. It closed the week above 5,000 anyway. That tells you the bid is too strong. The physical demand is too great. The paper suppression games don't work anymore when China bans rehypothecation and enforces delivery. When the manipulation tools break, price discovery happens. Real price discovery. And real price discovery in a systemically short market means prices that seem impossible become inevitable. Silver at $77 in the West, $86 in Shanghai, $9 premium holding for days. That's not noise. That's two-tier pricing emerging. Physical trades at a premium to paper. Shanghai trades at a premium to London. The arbitrage that used to keep prices aligned is breaking because there's not enough physical metal to move between markets fast enough. The United States federal government is running deficits at crisis levels before a crisis is even declared. $9.6 trillion in debt maturity over the next 12 months is refinancing risk on a scale never seen before. When you have to roll nearly $10 trillion in existing debt and fund $2 trillion in new deficits simultaneously, you need buyers. Lots of buyers. Willing buyers. But foreign central banks are reducing their treasury holdings. The Federal Reserve already expanded its balance sheet into the stratosphere and can't do it again without reigniting inflation. So who's left? Domestic buyers who are already overleveraged. Pension funds that are already underwater. Insurance companies that are already insolvent by any honest accounting standard. There is no natural bid big enough to absorb 11.6 trillion in financing needs without yields spiking or the Fed printing. If yields spike, the interest expense explodes and the debt spiral accelerates. If the Fed prints, inflation comes back and trust in the dollar evaporates. There is no good option. We are not at the cliff. We have already walked off it. Gold just printed its first weekly close above $5,000 ever. Bloomberg fabricated a Russia dollar story and got publicly exposed by the Russian central bank. China banned rehypothecation and is enforcing physical delivery across all off-exchange trading. Shanghai Futures Exchange silver inventory is 11 million ounces with only 126,000 added Friday to avoid default. David Morgan warned the U.S. government will stockpile silver because China controls 70% of global refining and the U.S. needs independence for AI and military applications. Gold ETF holdings keep falling while price keeps tripling. Only central banks are buying. Retail and institutions are selling. U.S. deficit hit $697 billion in 4 months. Net interest $1 trillion annualized. $9.6 trillion in debt matures in 12 months. Silver premium in Shanghai holds at $9 over Western paper. Physical delivery enforced. Fractional reserves scrutinized. The cartel's tools are broken. Same pattern. Same sequence. Same outcome. History doesn't repeat word for word, but it rhymes with mathematical precision. Rome clipped its coins and diluted its silver content until trust evaporated and commerce fractured. The Dutch Republic, once the financial center of the world, overextended its credit and military commitments until the weight of debt pushed it into irrelevance. Britain, master of global trade and issuer of the world's reserve currency, financed wars and welfare with borrowed money it could not truly afford. The pound sterling lost its dominance not because Britain announced surrender, but because the numbers made it inevitable. Debt outpaced production. Currency outpaced credibility. Confidence broke. Now look at the present. The United States carries debt levels that would have been unimaginable a generation ago. Deficits are normalized. Interest expense compounds. The currency supply expands faster than underlying productivity. This is not political. It is structural. Empires rise on productivity and discipline, and they decline on leverage and complacency. Once you recognize the pattern, you can't unsee it. Reserve currency status creates privilege, the ability to export inflation, to finance consumption with paper promises. But privilege always invites abuse. And abuse always ends the same way, with a reset. This isn't a conspiracy whispered in shadows. It's historical precedent backed by settlement records, bond yields, and central bank balance sheets anyone can review. When debt compounds faster than real growth, the outcome isn't theoretical, it's mathematical. Not maybe, not if. The only uncertainty is timing. Confidence-based systems don't decay slowly, they break suddenly. Liquidity feels endless until it isn't. Credit is easy until it disappears. The shift always blindsides the majority. Every monetary reset in history has triggered a wealth transfer. Wealth doesn't vanish, it migrates. It moves from paper promises to tangible assets. From currency savers to owners of real things, gold, silver, productive land, energy, infrastructure. Assets that cannot be printed or diluted overnight. This isn't speculation. It's preservation. When systems reset, purchasing power resets with them. By the time headlines confirm a crisis, repositioning is already underway. Markets signal stress before officials do. Gold breaking historic highs isn't symbolism, it's repricing risk. The data is public. The pattern is visible. When the ground shifts, positioning determines survival. History has run this cycle before. The only question is where you stand when it completes.